Hey friend, Steve here. Paying off debt with a life insurance policy is something that I'm a fan of. However, it's very important to make sure that your life insurance policy is set up to have as much cash value as possible, especially upfront in the first year, that is, if you're planning to use the policy to pay off debt. I recently met with a dentist who had bought a whole life insurance policy a couple of years ago. Now, she was putting away about $20,000 per year, and her plan was to use that policy to pay off debt. Here was the problem. The first year, when she made that $20,000 payment, she had about $12,000 in cash value. That's an $8,000 loss right out of the gates. And it would take 7 years at least just to get her money back. How are you going to use that to pay off debt if you're running a loss for the first 7 years? So it didn't make sense, and she said, why do people do this? I don't get why so many people are attracted to it. I said, I'm with you. Here's what you can do though. So looking at her situation, she's currently 30 years old. Now she has a large loan of $200,000 on the building that she bought for her dental practice. She wants to pay that debt off as quickly as possible. The interest rate on that loan is 6.25%, and she's paying about $3,000 per month on that loan right now. Now, because she is cash flowing, she has the cash, or I should say she'll have the cash over the next 3 years to completely pay the debt off. She said, I could pay 100 grand toward this loan this year, and then 50 grand next year, and 50 the following. I can do that no problem. But why we connected is because she reached out with an interest in first putting that $200,000 into a whole life insurance policy. And the reason why is because once a dollar passes through the cash value of a whole life insurance policy, when you borrow it out, you keep earning interest on it, meaning it keeps on compounding. So she can put the money into the policy, borrow it out, and at the same time get interest. When she pays it back, she's going to see her cash value restored to what it would have been if she just parked money in the policy and let it grow. It's like a high yield savings account that never stops earning interest. So here's what she wanted, or what she wants to do, I should say. She wants to deposit $200,000 into a whole life insurance policy. She wants positive cash value as soon as possible for 2 reasons. 1, she wants to pay off this debt, but 2, she has a bad taste in her mouth from the first whole life insurance policy with a 40% loss out of the gates and taking more than 7 years to get her money back. She's like, that's not gonna work for me. I need to see the money up front. And then after I put that 200 grand into the policy, I don't want to have to make any more payments. Show me the policy with nothing going in after that. So it's very easy to do that. So here's what we're gonna do. We'll break it down into 3 steps. Step 1 that I would do if I'm her is fund the life insurance policy. I would use the cash flows that she provided. So her plan is to pay off the debt with $100K this year and then $50K for the next 2 years. So what we're going to do is fund the life insurance policy with those dollar amounts. And after the 3rd year, we'll pay 0 forever. Step 2, take a loan to pay off that debt, which could be year 3 or very, very close to that. We'll look at paying it off in full in year 4 just to keep the model simple, meaning I pay for 3 years, year 4, I pay nothing, but I take money out to pay off the debt. And then step 3, we'll look to repay the loan. And what we will repay the loan with is what she's currently paying toward that loan, $3,000 per month. Sound good? All right, let's take a look at the illustration first. And here's what I want to hit on with this, the guaranteed values. She asked, after funding this policy with $200,000, I do not want to have to pay anything else in. Can you show me that this is possible? Here's what you can look at to make sure that this works. The guaranteed values. This displays an absolute worst case scenario. Outlay, 100K in the first year, 50K year 2, 50K year 3, 0 thereafter. It's guaranteed. Break-even point based on the guarantees. Check that out. Year 5. When we look at the non-guaranteed values, which we can look at, this is with Guardian, and I've seen them deliver, she breaks even year 3, meaning by the 3rd year, she's paid in $200,000 and she has $200,000. So she has a very cash-rich policy. She's at almost 93% of what she paid into the policy in the first year alone. That is the huge difference from what she had a couple of years ago when she took about a 40% loss on her money. Here, it's a 7% loss up front. So, step 1, fund the policy. There we go. Here's the policy that we just looked at. In yellow, you have the break-even point. It's actually a very flexible policy in the sense that she's only billed for this, the $5,500 per year, and then everything else she can add whenever she wants. The illustration assumes, though, that she pays all of it up front. What we also showed her was a different version of this product with the same company, where the first year she's got about 88% instead of 93% cash value, and it breaks even a year later, so year 4 instead of year 3. I don't think that she'll like this because she wants to use this fast to pay off her debt. However, it is something I like to show because when we look at it long term, you will see more value. For example, by age 50, she's got $465, whereas with the first option, she's at $437. And you'll see it pull ahead over time as well. So it is something we like to show folks. This way it's not just one option. That was a trap she fell into the first time, only seeing one option and saying, okay, sounds good, or looks good. But step 1, fund the policy. We'll look at the policy that provides the most cash value up front. Step 2, take a loan from the policy to pay off the bad debt. So here's a workbook that we let all of our clients use. Here's your cash value, and here's your maximum loan. So year 3, we've got just enough to borrow to be able to pay off the debt. What we're going to do is show the loan payoff in year 4, because at that point in time, you're not paying anything else in. So available equity, 207, we're going to take a $200K loan, even though the loan is likely going to be less by then because she would have paid on it for 3 years at the $3,000 per month. We're just gonna keep it simple at $200K. Okay, so $200,000 loan. Here we go. Your available equity here drops by the amount that you borrow. The loan interest rate in this example with Guardian is 5%. Loan balance, $200,000. Before we begin to repay it, I want to look at this. Why is she interested in flowing money through a policy first? Because she keeps earning dividends on the money she puts into a policy, even though she's borrowed it out. So when she pays it back, she doesn't lose that time. She keeps earning interest. So when she takes that loan in year 4, here's what I'm earning. That $72.48 that I still get on the cash value to the left. But if I borrow $200,000 at 5%, I pay $10,000, which means I have a loss of $2,700, meaning my net spread is negative in this particular case. So I'm negative here, but how quickly is that corrected? So she takes that loan of $200,000 and begins paying $3,000 per month immediately, which is $36K per year. And let's do that until the loan is paid off. And this $36K per year, by the way, is satisfying the principal and interest. So we're not paying the interest and then $36K. This is the total amount she's paying, just like what she's paying right now. There's the last year, clears the loan. All right, so wheat. So now what you can see as time passes is as she pays that down, the loan balance comes down. Look at this. Here's the power of just paying down your debts quickly. She pays it in the first year. That chips away at the total interest expense because loan interest on a life insurance policy will accrue over the course of the year. If you're throwing money at it every month, you are going to save yourself interest. So in this example, her spread is less than $1,000 now. And then beginning the next year, she's positive, meaning the interest she's earning is exceeding the interest she's paying. And then when it's paid off, there's my annual growth every year, and my cash value is fully restored and just keeps on compounding. So I keep getting the yield that I saw over here. Now this will vary a little bit if the product is direct or non-direct recognition, but that doesn't make much of a difference when you look at the net numbers. Anyway, to recap the strategy, this works out great for her because her money keeps compounding over time. But what she's looking to do, fund the policy for 3 years, pay nothing after that. She wants to keep funding, she can now, but we're setting it up so she doesn't have to. Take the $200K loan, pay off the bad debt, measure the cost of the interest to see, am I positive or negative? This way she has awareness of what's good and bad. And then third, repay that loan just like you're repaying this loan. The benefit is you have a lower cost to borrow, you have more control because with life insurance loans, you can pay them back however you want, whenever you want. They don't impact your credit or anything like that. So you've got a lot more freedom. And then the big win at the end is that your money keeps on compounding. So when it comes to paying off debt with a life insurance policy, I am a huge fan of it for all of those reasons. And the thing that I like the most is the fact that you have control and all of your money is there when you pay it back. Hope you enjoyed this one. We'll see you in the next video. Thanks so much.